Welcome to the Titans of Industry show. Thank you for joining us today. I'm thrilled to have on John Williams, founder of the famous ShadowStats newsletter and website. What we're going to do today is go over certain key graphs which John has kindly shared with us from his work. John, how are you?
Fine, thanks, Leor. How are you today?
I'm very well, and I'm excited to go over these charts because ShadowStats it does a marvelous job of showing another aspect of how to create statistics, and I love your work. So let's get started with looking at the first chart. It's the official unemployment rate. So people are seeing this on screen, and so the U3 is under 5%, but you have it at over 20%. So ShadowStats statistics says that every fifth person in America is out of a job currently.
Yes, effectively. What you'll see here, we are still in a very difficult economic circumstance here. I'll contend the economy has not recovered as it has been popularly touted. And because of a redefinition of economic theories over the last several decades, a lot of economic weakness gets masked. For example, if you look at specifically the unemployment rate, that series was redefined back in 1994, which is the beginning of that graph. And what they did at that time was it's all in how you count who's unemployed in your headline number. In order to be counted as unemployed, you have to have, of course, be unemployed, but you have to have been looking actively for work in the last 4 weeks. And what's happened is, particularly after NAFTA and other factors that came in and put people on protracted unemployment, people gave up looking for work, and the government considered them what they call discouraged workers. They no longer get counted in the headline labor force, and the headline labor force is the one that's calculated and is used in calculating that line. Those are the people who are not discouraged that they're currently looking for work. But if you become discouraged because you can't find a job, then you get thrown into what is now called the U6 category. That's the middle line. But that was redefined in 1994 to exclude people who'd been discouraged for more than a year. Prior to 1994, you were just counted as a discouraged worker, irrespective of the amount of time that you'd been discouraged. I estimate what we'd be showing if it counted it the way it was before 1994, and again that was before NAFTA, and it wasn't coincidental that the new series was put in place at that time. And basically what you find is that the broad unemployment number, including people who effectively are now displaced workers, would have been higher all along here, but you've just begin to see a little bit of a downturn in that. There have been some of the longer-term discouraged workers, or the underlying discouraged workers, headline discouraged workers, being brought back into the labor force. Not much, but it is actually down a little bit.
Interesting. So, okay, John, I want to focus on this for a little bit. So, 20% unemployment, that's like 65 million people out of work. Which cities are they living at? Predominantly.
Well, this is countrywide.
Of course. That's why I'm asking, where are the most inflicted places? Where are the places where it's tough? 20% is very bad. I mean, in Norway, 20% unemployment is common because the government pays a lot of the benefits and entitlement through oil profits. But in the U.S., 20% is insane. And so where are all these people?
Well, these people are not receiving unemployment insurance. These generally, it's the jobs have been lost in the industrial sector, the production sector. That is so you look at the industrial heartland. That you probably have some greater concentration there, but that's the jobs have been lost primarily in the higher paying production areas.
Understood. Okay. Well, with John, with such a highly aging population base, I mean, you've got somewhere close to 80 million boomers. I mean, we have to confront the fact that unemployment will be on average higher than in previous generations. As a matter of fact, right? People are retiring. They're living 20, 30 years after retiring. Is this the new norm to have high unemployment in the U.S.?
Well, again, what we're seeing here is that a lot of people who expected to be retired at this point in time find they're not able to retire, that they have to keep working in some form to support themselves. Things are not quite as everyone had thought they would work out 10, 20 years ago.
Understood. Okay. Well, we're looking at the next chart, which is the consumer inflation. This is one of the things that you're most famous for because of your hyperinflation predictions, and the new measure, which excludes food and energy, is under 2%. And of course, we all know that the Fed is saying that they have failed to meet their target inflation rate. Using the 1980 formula, it's like 10%. And so, what's the big difference between the 1980 and the new way of measuring inflation?
Well, there are two levels, and they're about evenly split in terms of their impact. One is the substitution effect, and this is what you have to consider here is what you're trying to measure with a consumer price index. If you're trying to measure inflation, if you're an individual and you're looking at inflation, you're saying to yourself generally, okay, here's whatever my cost of living is here. I certainly want to maintain this enough income growth to cover my cost of living so that I'm not falling behind or making investments, that at least my investments keep up with my constant my cost of living. And the way most people look at it and the way it has been viewed historically, and I'm talking literally over 100, 200 years, there have been price indices around for a long time. And it's a constant measure of, it's a measure of a constant standard of living. So that what they'll do is what they used to do, they take a fixed basket of goods, say very crudely a pound of steak, a gallon of gasoline, and a loaf of bread. You'd price them out one year. You'd price the same thing out the next year, whatever it had gone up in price. That was your rate of inflation. Well, back in the 90s, early 90s, Alan Greenspan led the fight to change the CPI. He said, the consumer price index overstates inflation. And if only we had a more realistic number, it would help cut the budget deficit because we could cut back on cost of living adjustments and such for Social Security. Well, if you asked him what he meant by the CPI was overstating inflation, he'd tell you very simply, give you the example. Well, suppose steak goes up in price sharply and people start buying more hamburger. Then it's not costing them as much, but that's not reflected in the CPI. Well, of course it wasn't reflected in the CPI because the CPI was a measure of maintaining a constant standard of living. If you don't think that hamburger is the equivalent of steak, you're seeing then a lowered standard of living. If that's if you have to buy the hamburger because you can't afford the steak. The way that
you keep on eating, so we don't care if it's steak or hamburger. The inflation has not changed materially for you. And obviously,
That's
eating steak is not like eating hamburger, and driving a Porsche is not like driving a Honda. So,
right. Well, that's a substitution effect. So you can, if something goes up in price, you substitute. You may, from a practical standpoint, substitute a product that's less expensive, not necessarily the same quality, and that's the. I'm sorry?
How often do they substitute items?
Well, it's what they did was they worked formulas into the modeling to adjust for that. The CPI, the headline CPI, has never fully been converted over to substitution because of definitional issues in it. They have a new series called the chain-weighted CPI, which is fully substitution-based, and that goes up or down. Things get automatically reweighted depending upon the relative movement of prices. It's mathematical. It's not that they actually measure the how things are shifting, but it's the difference that it makes there in terms of the changes that they've made. And they do the same thing with where you buy things. If in the United States, if you bought if you used to buy a suit of clothes at a tailor downtown, and you paid a certain amount, and now you end up going out to a mall and buying it at a discount place, you're not buying the same quality suit, or you're not having the same quality experience. They shift the weighting as to where things are purchased. There are a whole variety of shifts that shift items towards the less expensive. And the effect there is that it accounts for about 3 percentage points of the CPI from where it was before they made these changes in the 90s. But there's another element as well, which is what they call hedonic quality adjustments. And that is, a government determines that there's a product is better, and it's related to the substitution element to a certain extent. But here, a product improves, and so they adjust the price of the product downward to reflect the fact that you have this quality improvement. But the average person doesn't necessarily recognize that, or may not even be willing to pay for it. Just doesn't have a chance to make a choice. I'll give you an example, and this is was way back in time, but it's a real simple one. The government mandated a change in gasoline formulation to improve air quality. When it went into effect, it increased the price of gasoline by 10 cents per gallon, which was a pretty good increase in the day that happened. Well, the government did include it in the Consumer Price Index, the increase, because they contended it was a quality improvement. Yet the average guy who's filling his tank of gas to drive to work was moaning and groaning because it was costing him a lot more to drive to work. He wasn't recognizing that he was getting better air quality somewhere down the road. And again, it's a matter of what you're looking at for the Consumer Price Index. You can define it in all sorts of ways. From the individual standpoint, most people are looking for constant quality and a measure of what they spend out of pocket. You can come up with all sorts of economic measures that say, because of quality, things are really getting a better product here. People are willing to substitute. So it's a matter of how you want to work it. For the individual, you want to be able to cover out of pocket and maintain the quality of living. From the government standpoint, they want as low an inflation rate as possible because that lowers what they have to pay in the way of adjusting things such as cost of living adjustments for Social Security. And the way our tax structure is, it also boosts income tax brackets for individuals. So it really helps them both in terms of revenue collection and lowering expenses. My contention is that effectively it's a tax on the consumer. I mean, why not just raise taxes if you're trying to use this to balance a budget deficit? This is a subterfuge. They're using this as a way to avoid raising taxes, or for someone in Congress voting against Social Security. It's not honest, and the problem is the average guy doesn't fully realize this. So he'll take the government's numbers and forget what the government pays him. In the private sector, a lot of companies raise salaries based on the government's headline inflation number. So the average guy's not getting an adequate increase in his income to cover his expenses. A lot of landlords raise their rental fees based on the headline inflation, and they're not getting adequate compensation for that. It's what's happened from the standpoint of giving the government a low inflation rate to help them artificially reduce their spending is being accepted in the broader world, and a lot of people find their living quality, their standard living declining, and not fully understanding why.
So where are people feeling the burden most? What's most inflating in the last few years? What's most?
It's reasonably well spread. You get things. I'll give you an example. I mean, then there are elements here that gets a little more complex. You look at computers or cell phones. I'm not a real high-tech guy, but I use a computer in terms of writing my newsletter and my calculations. I use basically the same stuff I used 10 years ago. I don't need all the big memories. I don't play movies or view television on my computer. 5 years ago, I bought a new computer. It replaced one I'd bought maybe 10 years ago. And where I spent $1,000 10 years ago and I replaced it 5 years ago, it cost me $1,000. That was what I paid out of pocket. It did the same thing for me, and they do all these quality adjustments. What they didn't have to what they don't compensate for is I had to learn how to run these more advanced programs. I could use my old programs on it. There are a variety of things that were negatives as far as I concerned, reduce the quality. You didn't tend to find those there. But from my standpoint, I said, yeah, okay, you don't have any inflation there in computers. Well, the way the government looks at it, of course, you've had this tremendous increase in memory, and that does increase the quality of the product. And my contention would be if you have a big shift in the technology, just reintroduce it as a new product and start at a different level. If a person who's buying it doesn't have the chance to buy what he really wanted, then he's being forced to buy what's there. And the difference is, if I bought the government's numbers in terms of inflation, the computer that I bought for $1,000 against the product I was replacing, I should have been able to buy for $50. That's how much it had been deflated because of the quality improvements. But I couldn't buy that computer for $50 anywhere. I mean, I had to pay $1,000 for getting the same computer, from my standpoint, that it had the prior period. So it's there are all sorts of shaded areas here, but my contention is that you can. It's easily worked. I mean, you make certain assumptions. You do certain recalculations. Again, just call something a new product when there's a big shift, and don't use the hedonic adjustments to give people lower prices and quality improvement where A, they may not see it, and B, they may not want to pay for it and not have an option not to pay for it. So that between the hedonic adjustments and the substitution effects, you have an aggregate change here since the early 1980s of about 7 percentage points. big part of that's in the housing sector. And then, in fact, almost I think it's over 40% of our CPI is tied to your home. That's one of the worst areas. It's all guesstimates. It used to be they had an element of that was tied to the value of a house. When they go out and buy a house, that was housing prices went up. That increased inflation. Now what they've done, and then what they did back in the 80s, and that's how long this is. I've gone back and re-estimated things. They recalculated things. First is to what you'd pay yourself as a homeowner to rent your own house. So the home cost includes a big component of what's called homeowner's equivalent rent. What the government figured you'd pay yourself to rent yourself your house. And then each month they try and figure out how much more you'd charge yourself. If you think that's a realistic number, I've got some other ones for you. But that's the effect there. When they made the change, the government estimated it would knock almost 1.5 percentage points per year off the annual inflation rate on for the whole series, and it did. And that's aggregate. Had 1.5% lower inflation this year, 1.5% lower inflation next year than would have been reported otherwise, and that builds up over time. So that's why you see these this differential that's built up over time in the chart.
John, let's look at participation rate. So we're looking at participation rate. It's very low as compared to 25 years ago. It was 66 back then, peaked at around 67.5. Now it's for a number of years, it's below 63%. Is that, first of all, is this a meaningful change? It's like 4% in 20 years. Is that a meaningful change? And secondly, is this normal? I mean, looking at other advanced and modern countries, Canada, Europe, Australia, are we seeing the same thing, or is this abnormal?
Yeah, I'm sorry, you're talking the civilian employment population rate? Population ratio?
No, the one before it, it's called participation rate.
Oh, the participation rate, okay. That's, it's tough to compare countries. Again, this in terms of the number, this is a part of the issue here is how they define the unemployed. The participation rate, it's a labor force as a percent of the population. So the labor force is defined as the number of people who are employed and the number of people who are unemployed. So if they're understating the number of people who are unemployed, the participation rate drops. And when you say big drop, as you're seeing here, that also tends to reflect a large increase in the long-term discouraged workers, the displaced workers. And I think that's largely what you're seeing here. But people and the Fed will say, well, oh boy, at this rate here, that's the equivalent of, they look at the related unemployment rate that we have right now, which is under 5%, and they'll say that's full employment. But where this is different, and the reason I have this here, and I probably should go back and look at that unemployment rate, what you'll see is with a headline number, at 5%, 4% unemployment is the type of thing that was seen. Let's say back in before the recession in 2007. But the participation rate then was up, was significantly higher, and the difference there is what's happened to the nature of the makeup of the unemployed. Again, you've got a big surge in the long-term unemployed. My contention is that where there's some in the Fed saying now, okay, we're at full employment. You don't get that impression with the average American. There are a number of things that indicate you're not at full employment. I would contend that you have to look at it not just at the headline unemployment rate, which doesn't include those long-term discouraged workers, displaced workers. You've also got to look at the participation rate, or the employment to population ratio, which is another measure there. And what you'll see is that the participation rate, where it is now, is historically consistent with about a 9 percentage point unemployment rate, with a headline unemployment rate, the way it used to be. I mean, just over time, they've been. If we were seeing a normal circumstance here, not such heavy long-term displaced workers, your headline number, if you're going back and forth, people coming and going out of the labor force, you'd have you at about 9%. We're not seeing that. So it's not to say that this is represents full employment is, I think, highly misleading.
John, with regards to the real S&P 500 quarterly revenues per share, and
right.
You adjust it for share buybacks, and then
and inflation.
And inflation, correct. So, can you explain what is the bottom line, the theme of what this chart basically wants to prove?
Well, what I'm looking at here very simply is that if you believe the government's headline numbers on the broad economy, the economy hit a peak back in 2007. I think it was maybe a little bit earlier than that, but the government's version is end of 2007. The economy's at a peak. It falls off sharply. Virtually collapses at certain times in its downturn, hitting a trough in 2009. I think 2009 was the trough. So I'm not arguing with him too much about the general pattern there. The problem is what happens after 2009. If you look at the GDP numbers, the official GDP numbers, the economy rebounds. I think it's by the end of 2011, it regains the level that it had before it started to turn down, and today it's about 13% higher than the prior peak in the economy before the recession. Now that's net of inflation. If that were true, you should be seeing similar movements in a variety of indicators. One of the broadest ones is corporate revenues. And if you look at what I'm trying to estimate there with the S&P 500, and it's a calculation I go through with a variety of numbers to get there, it gives you an indication of what effectively is a large portion of corporate revenues in the United States. That should be showing the same pattern as the GDP. You should be seeing a strong recovery there in the revenues if the GDP is that strong. But you're not seeing in that. There are a number of other indications ranging from the housing area to production, and you just don't see a booming economy with the major subsidiary series not recovering.
Now, so the chart, it excludes share buybacks. Why is that?
Well, it's a popular way of inflating your performance. If someone's looking at earnings per share or revenues per share, if you go in and you buy back the shares from the public, the number of shares declined, but your revenue or your earnings aggregate basically should be the same. So you're dividing by a smaller number of shares, and as a result, you get a higher earnings per share or revenues per share than you'd have without the buybacks. So the buybacks have the effect of inflating those per share measures that people popularly follow. So I'm just taking the per share out of it. If I could get an aggregate income number for the S&P 500, which effectively this should mimic, I would just use that. But this is designed to mimic what the total revenue is for the S&P 500 net of inflation.
That's interesting. By the way, with regards to share buybacks, there are times where share buybacks are incredibly valuable and important for companies if the company is trading for cheap valuations and very profitable. Buying back your own shares is a very important and a very astute decision by management. But if you have to borrow money in order to buy back shares, which would equate what you're saying, which is to inflate per share earnings, then yes, that will be that will be something you want to exclude in order to see a real picture of the company. And because most companies in the S&P right now borrow, well, I wouldn't say most, but an excessive amount compared to the historical average are borrowing in order to make this, then yeah, obviously the chart plots a theme here. John, I want to thank you very much for coming on the show, Encyclopedia of Statistics, and we'll feature all of these charts while the show airs, so people can follow. And again, thank you very much. Again, your website, please, for our listeners, some of the ways that people can get involved.
The website is ShadowStats.com. The homepage has a lot of information on it. Left-hand column, we put out a regular weekly electronic newsletter, which is by subscription, but you get to see all the headlines there. And we always welcome new subscribers. On the right-hand side, you'll see our alternative measures. Graphs on those, you click on those, you get to see some of the numbers. And you'll see there are also a series of publicly available papers that discuss a circumstance with inflation and with employment, and some background papers on the long-term economic problems and why eventually the United States is headed for hyperinflation.
John Williams, thank you very much.
Thank you, Leo.